There is a moment in every bull market when doubt enters quietly, not with panic, not with headlines, but with a subtle loss of momentum that only seasoned traders recognize. It feels confusing because nothing catastrophic has happened. No structural collapse, no dramatic policy reversal. Yet prices begin to slip, confidence fades, and investors start asking the wrong question. They ask, "Is it over?" instead of asking, "What is the market waiting for?" Today is Wednesday, 18th February, and what we are witnessing in gold and silver is not the end of a bull market. It is hunger. There is an old principle professional traders live by. A bull market must be fed. It requires continuous fundamental nourishment, new catalysts, new developments, fresh reasons for capital to stay aggressive. Without fresh fuel, even the strongest rally pauses. And when it pauses, weak hands begin to exit. That is where we are right now. Gold fell $85 in a single session. Silver dropped more than $3. Spot silver slid roughly 2% early in the day. Spot gold declined over 1% to 4.31. April gold futures fell 85.60 to trade at 4.60 an ounce, nearly a 2% decline. March silver dropped 313 to $7,483. Mining stocks amplified the pressure. Hecla Mining, owner of the Greens Creek mine in Alaska, declined 3% before the market opened. Endeavor Silver fell 3.5%. First Majestic Silver lost nearly 4%. Kerr Mining dropped 3.4%. Teck Resources and Silvercrest Metals both declined around 3%. Even Wheaton Precious Metals, despite announcing a massive $4.3 billion streaming deal, fell more than 2%. The leveraged products were hit hardest. ProShares Ultra Silver declined 7% in pre-market trading. iShares Silver Trust and Aberdeen Physical Silver Shares ETF each fell more than 3%. If you are watching your portfolio today, it feels painful, but pain does not equal collapse. This is long liquidation. This is short-term positioning unwinding. This is traders who bought the rebound after January deciding that without new headlines, they would rather step aside. The structural story has not deteriorated. Let us rewind. Earlier this year, silver surged above $120. Gold reached new all-time highs. Momentum was aggressive. Sentiment was overwhelmingly bullish. Precious metals dominated financial conversations. Then came the violent reset, the Kevin Warsh nomination, the leveraged position unwind, and the 30% single-day crash in silver futures, the worst since March 1980. That event flushed out an entire layer of speculative excess. Since that reset, markets have stabilized. Buying returned gradually, but the critical ingredient, fresh fundamental acceleration, has been absent. Short-term traders thrive on momentum. They need new reasons to hold risk. When no new catalyst emerges, they rotate capital, they liquidate, they chase something else. That is exactly what you're seeing now. This is not a breakdown in supply-demand fundamentals. It is not a collapse in industrial consumption. It is not a permanent shift in monetary policy. It is impatience. Bull markets do not move in straight lines. They climb in waves. Each wave requires fuel. Without it, consolidation follows. And consolidation always feels worse than it is. The real question is not why gold fell $85 today. The real question is what catalyst will feed the next leg higher. There are three major forces developing right now that could provide that fuel. The first is the Iran situation. Today, Iran and the United States met for a second round of nuclear talks in Geneva, Switzerland, mediated by Oman. The objective is to avoid renewed conflict in the Middle East following last year's U.S. strikes on Iranian targets. Iranian officials have indicated willingness to discuss nuclear enrichment, but they are tying any concessions to potential easing of American sanctions. Meanwhile, both sides are increasing military presence in the region. The United States is deploying a second aircraft carrier to the Middle East. Iran's Islamic Revolutionary Guard Corps conducted drills near the Strait of Hormuz earlier this week, emphasizing readiness to respond decisively to security threats. The U.S. delegation includes Middle East envoy Steve Witkoff and President Trump's son-in-law, Jared Kushner. President Trump stated Monday that Iran wants to make a deal and that he will be indirectly involved in the discussions. This creates a binary outcome. If negotiations succeed and tensions ease, safe haven demand could soften temporarily. Some of today's weakness likely reflects optimism that diplomacy may prevail. Reduced crisis hedging removes urgency for immediate gold and silver buying, but if negotiations collapse, if tensions escalate, or if military action occurs, precious metals could spike sharply. The Strait of Hormuz remains one of the most strategically critical waterways in the world. Any disruption would ripple through global energy markets. Oil would surge. Risk sentiment would deteriorate. Capital would seek safety. That catalyst remains unresolved. It sits directly ahead of us. The second force involves China. Chinese Foreign Minister Wang Yi met with U.S. Secretary of State Marco Rubio in Munich last week. Both sides are preparing for a planned April visit by President Trump to Beijing. Wang described 2026 as an opportunity to move toward mutual respect and strengthened cooperation. On the surface, Diplomatic progress might reduce immediate geopolitical fear premiums, but the deeper implications for precious metals are complex. China is the world's largest consumer of industrial silver. It is a significant buyer of physical gold for central bank reserves. The January surge that propelled silver above $120 was heavily influenced by Chinese participation. Improved U.S.-China relations could stimulate global trade and manufacturing expansion. A stronger global economy increases demand for silver in solar panel production, electronics manufacturing, and electric vehicle development. Diplomacy does not eliminate precious metals demand. It reshapes the drivers. And then there is the third catalyst, monetary policy. The benchmark 10-year U.S. Treasury yield currently sits around 4.03%, a 2.5-month low. Falling yields signal growing expectations of Federal Reserve easing. Markets are pricing a rate cut in July, with increasing speculation about a possible move in June. If the Federal Reserve begins cutting rates, that would represent the most powerful fresh fuel this bull market could receive. Lower rates reduce the opportunity cost of holding non-yielding assets like gold and silver. They typically weaken the dollar. They signal economic concern, which historically strengthens safe haven demand. Inflation data has been softer. Labor markets are cooling. The groundwork for policy easing is forming. The bull market is not broken. It is waiting to be fed. Now here is what most investors miss during moments like this. Markets do not reward emotion. They reward positioning. And positioning is happening quietly while attention is focused on red numbers. This week, Deutsche Bank released an observation that should completely reshape how you interpret current silver prices. According to their analysis, silver is trading roughly $7 below its inflation-adjusted price from the year 1790. Pause and absorb that. When you adjust for more than 2 centuries of monetary expansion, currency debasement, economic cycles, wars, policy shifts, and repeated inflationary waves, silver today remains cheaper in real terms than it was in the late 18th century. Despite modern financial engineering, despite central bank balance sheet expansion, despite trillions in stimulus, despite persistent currency erosion, silver has not kept pace with the long-term decline in purchasing power of fiat money. That is not speculation. That is historical comparison. And it tells you something extremely important. This market is not overvalued by historical standards. Even after rallying above $120 earlier this year, even after the surge that captured global attention, the metal is not stretched when viewed across centuries. That changes the context of this pullback. This is not a bubble bursting. This is positioning, resetting. While retail traders react to a $3 decline, institutional capital is making decisions measured in billions. BHP, one of the largest mining companies in the world, just completed a $4.3 billion silver streaming agreement with Wheaton Precious Metals. This is the largest silver streaming transaction ever executed. Under this agreement, BHP receives $4.3 billion upfront in exchange for delivering silver production from its Antamina mine over the long term. Ask yourself a simple question. Why would BHP lock in such a deal now if executives believed silver prices were peaking? Why would Wheaton commit $4.3 billion in capital today for silver to be delivered over years and decades if they expected prices to collapse? They would not. These are not emotional traders reacting to daily volatility. These are global institutions allocating capital based on long-term structural analysis. They see supply constraints. They see demand growth. They see monetary shifts forming beneath the surface, and they are acting accordingly. Meanwhile, many retail participants are selling because prices fell 2 or 3% in a session. This is how wealth transfers occur in markets. Structural fundamentals remain intact. Silver demand from solar panel manufacturing continues expanding. Renewable energy build-out requires significant silver input due to its superior conductivity. Electronics manufacturing depends on it. Electric vehicle production adds further consumption pressure. Emerging technologies increasingly incorporate silver in components and circuitry. These demand drivers did not disappear this week. On the supply side, constraints persist. New mine development takes years. Permitting processes are complex. Environmental standards are tightening. Capital investment cycles in mining lag price signals. Structural deficits cannot be resolved overnight. Yet price action in a few sessions can distort perception. This is where discipline matters. If you are holding physical gold or silver as a long-term allocation, nothing fundamental changed today. The monetary environment remains fragile. Global debt levels remain elevated. Central banks continue diversifying reserves, particularly into gold. Industrial demand for silver remains structurally embedded in technological transformation. If you are looking to accumulate, corrections create better entry conditions. Prices are lower than they were last week. Sentiment has cooled. Speculative excess has been flushed further. The risk-reward balance improves when emotional selling increases. If you hold mining equities, understand the leverage dynamic. When silver falls 2%, Mining shares often decline 3 to 5% because of operating leverage and margin sensitivity. But the reverse is equally true. When silver rallies, miners can outperform significantly. Short-term volatility does not equal long-term impairment. For traders operating in shorter time frames, recognize that we are in consolidation. January's 30% single-day crash in silver futures, the worst since March 1980, forced a violent reset. Markets require digestion after such events. Positioning rebuilds gradually, capital rotates cautiously. Aggressive directional conviction requires catalyst confirmation. And that brings us back to the three developing forces. First, Iran. Diplomatic negotiations continue in Geneva. Military presence remains elevated. The United States is deploying a second aircraft carrier. Iran's Revolutionary Guard conducted drills near the Strait of Hormuz. The outcome is uncertain. If talks succeed, safe haven demand could ease temporarily. If talks fail, geopolitical escalation could drive oil prices higher and send capital rushing into precious metals. This is a live variable. Second, China. Diplomatic engagement between Wang Yi and Marco Rubio in Munich sets the stage for the April summit between President Trump and President Xi in Beijing. Improved relations could reduce immediate geopolitical fear, but stronger economic cooperation would likely boost industrial silver demand. China remains the world's largest consumer of industrial silver and a major buyer of gold for reserves. The January surge above $120 in silver was heavily influenced by Chinese participation. Diplomatic stability does not eliminate demand. It redirects it toward industrial expansion. Third, monetary policy. The 10-year Treasury yield sits near 4.03%, signaling growing expectations of Federal Reserve easing. Markets are increasingly pricing a July rate cut, with rising probability of June. Inflation data has softened. Labor indicators are cooling. When the first rate cut occurs, it will mark a shift in policy cycle. Lower rates reduce opportunity cost for holding gold and silver. They often weaken the dollar. They signal economic caution, historically boosting safe haven flows. That is powerful fuel. Any one of these catalysts could reignite momentum. All three together could accelerate it dramatically. The key distinction is between temporary positioning weakness and structural transformation. The structural case remains. Monetary expansion over decades has eroded currency purchasing power. Silver remains historically undervalued relative to inflation-adjusted benchmarks. Institutional capital is committing billions to long-term silver exposure. Industrial demand continues expanding. Supply remains constrained. Price weakness in the absence of new headlines is not collapse. It is pause. Markets do not move because investors feel comfortable. They move because catalysts force repricing. Right now, repricing is waiting for ignition, and ignition rarely announces itself in advance. The investors who benefit most are rarely the ones who react after the move begins. They are the ones positioned before it. Now let's step back and connect everything clearly, because markets reward clarity, not reaction. Gold did not fall $85 because the long-term story collapsed. Silver did not drop $3 because industrial demand suddenly vanished. Mining stocks did not decline 2 to 4% because supply constraints disappeared overnight. Leveraged ETFs did not fall 7% because the structural thesis broke. They fell because short-term traders needed a reason to stay, and they did not get one. That is the difference between structural deterioration and positioning fatigue. April gold futures dropped $85.60 to trade at $4.60 an ounce. March silver fell 3.13 to 7,483s. Spot silver was down roughly 2% early in the session. Spot gold declined more than 1% to 431. Hecla mining fell 3% before the open. Endeavor silver dropped 3.5%. First Majestic silver declined nearly 4%. Kerr mining fell 3.4%. Teck Resources and Silvercrest Metals lost around 3%. Wheaton Precious Metals, despite announcing a $4.3 billion streaming deal, declined more than 2%. ProShares Ultra Silver fell 7% in pre-market trading. iShares Silver Trust and Aberdeen Physical Silver Shares ETF both dropped more than 3%. Those numbers are real, but they represent movement, not meaning. Meaning comes from structure. The structure has not changed. Three catalysts remain on the horizon. Iran's nuclear negotiations are ongoing in Geneva. The United States has deployed a second aircraft carrier to the Middle East. Iran's Islamic Revolutionary Guard Corps has conducted drills near the Strait of Hormuz. President Trump stated that Iran wants to make a deal and that he will be indirectly involved. If diplomacy succeeds, safe haven demand may ease temporarily. If talks collapse or escalate into military confrontation, precious metals could surge quickly. The Strait of Hormuz remains one of the most strategically critical choke points in global energy supply. Any disruption would reverberate across oil markets and global risk sentiment. That variable remains active. U.S.-China diplomacy is evolving ahead of the planned April summit between President Trump and President Xi in Beijing. Wang Yi and Marco Rubio met in Munich. Both sides describe the need for strengthened dialogue and cooperation. Short-term easing of geopolitical tension may reduce fear premiums, but long-term cooperation would likely increase industrial silver consumption through renewable energy expansion, electronics production, and electric vehicle development. China remains the largest consumer of industrial silver globally and a significant buyer of gold reserves. The January surge above $120 in silver was heavily influenced by Chinese market participation. That dynamic has not disappeared. Monetary policy remains the most powerful potential catalyst. The 10-year Treasury yield sits near 4.03%, a 2.5-month low. Markets are increasingly pricing in a Federal Reserve rate cut in July with rising probability of June. Inflation data has come in softer. Labor markets are cooling. When the first rate cut arrives, it signals the beginning of a policy shift. Lower rates reduce the opportunity cost of holding non-yielding assets like gold and silver. They often weaken the dollar. They historically coincide with rising safe haven allocation. That is fuel. Meanwhile, Deutsche Bank's analysis shows silver trading roughly $7 below its inflation-adjusted price from 1790. After 235 years of monetary expansion, silver remains undervalued relative to historical purchasing power. And BHP's $4.3 billion silver streaming agreement with Wheaton Precious Metals, the largest in history, reflects institutional conviction in long-term silver value. These are not emotional decisions, they are strategic commitments. The question now becomes personal. What type of investor are you during consolidation? There are always three types. The first reacts emotionally. They see red numbers and assume something must be wrong. They sell to reduce discomfort. They lock in losses at moments when structural conditions remain intact. The second freezes. They hesitate. They wait for clarity that never arrives before price moves again. Opportunity passes while they remain undecided. The third evaluates fundamentals relative to price. They understand that corrections driven by absence of catalysts are not the same as corrections driven by structural breakdown. They recognize that supply deficits persist. Industrial demand remains. Monetary policy is shifting. Geopolitical uncertainty is unresolved. They act based on framework, not fear. This is not about predicting exact timing. It is about recognizing imbalance between short-term positioning and long-term structure. Right now, weakness reflects impatience. Bull markets require feeding. Fresh fodder has not yet arrived. But Iran negotiations, U.S.-China diplomacy, and Federal Reserve policy decisions are all active variables. Any one of them could ignite the next leg higher. All three together could create acceleration. When that ignition occurs, prices will not wait for consensus. They will move before headlines fully adjust, and those positioned beforehand will not need to chase. Long-term holders of physical metal should understand that today does not invalidate their thesis. Accumulators should recognize that pullbacks improve entry conditions. Mining investors should accept volatility as leverage. Traders should respect consolidation and wait for confirmation. The structural forces remain. Monetary expansion has eroded fiat purchasing power over decades. Central banks continue diversifying into gold. Industrial transformation supports silver consumption. Mine supply remains constrained by time and capital. Nothing in today's price action reversed those realities. Markets transfer wealth quietly during moments like this. Emotional sellers provide liquidity to disciplined buyers. Billion-dollar institutions commit capital, while retail investors debate whether a 3% drop signals catastrophe. The wealth transfer is not loud. It is mechanical. There is a reason experienced traders do not panic during consolidations. They understand that the absence of fresh fuel does not mean the engine has failed. It means it is waiting, and fuel is forming. Iran, China, the Fed. Three potential sparks. The only variable you control is positioning. When the next catalyst arrives, gold and silver will not send invitations. They will move. And by the time certainty returns, price will already reflect it. Right now, conviction is being tested. The structure is intact. The catalysts are near. The pause is temporary. The opportunity is real. The question is simple. Will you react to temporary weakness, or will you recognize it as preparation for the next advance? That choice determines which side of the wealth transfer you stand on. And markets, as always, will reward clarity over emotion.